Well, the last several shows have been discussing a potential credit crisis brewing in the banking system in the United States, having to do with these NDFI loans. That is a credit type crisis developing. But I want to share with you something I saw today. We also have a major liquidity crisis growing that will have a disproportionate impact, I believe, on the regional and mid-sized banks in this country, just like we saw in 2023 with the failure of SVB Bank, which set off a whole cascade of events. Love to get your thoughts and input. Sorry, the sound's a little different today. I don't have my regular microphone, so I'm just recording here on the iPhone. Hopefully it's clear enough and there's not too much feedback. So this morning I see on X the Kobayashi letter, and he says, breaking, bank reserves at the Fed dropped $59 billion last week to $2.93 trillion. The second lowest since January 2023. And why is that important? It's because that amount basically matches the low from 2023, just before the regional banking crisis unfolded. And it says reserves are now on track for their third consecutive monthly decline. This comes as the Treasury increases debt issuance to rebuild its cash balances following the debt ceiling increase in July, draining liquidity from the banking system. Okay, so that's from the Kobayashi letter on X. But I look back at kind of the cycles with the liquidity run up, drain down, and then what happened. So March 2022, U.S. bank reserves total were at 4.1 trillion. That was the pre-quantitative tightening peak. As you know, if you're paying attention now, the Federal Reserve is on another quantitative tightening cycle, right? February 2023, the total U.S. bank reserves dropped to 2.9 trillion. That was just before the SVB banking collapse. I'm going to share with you in a quick second. I pulled a summary of the market losses that, were incurred from the 2023 U.S. banking liquidity crisis, not credit crisis. So March 2023, U.S. bank reserves are back to 3.3 trillion because the Fed was forced to step in and add liquidity, to the system. In late 2024, the reserves were at 3.1 trillion. Gradual quantitative tightening resumes, but now it's back to 2.93, and this is a major danger zone. Okay, let me just back into what happened in 2023, meaning market losses, because this affected everything. Okay, if you guys are in stocks, if you're in bonds, if you're in any kind of investment category, if we are embarking, and you have to wonder, and I'll explain it to you in a second, if this is a intended action by the Fed to trigger the next crisis, right? Because what it does is it results in a consolidation, guys, of the smaller banks into the larger banks, right? The larger banks get bigger, too big to fail. They get more powerful. Okay, that's what happened after the 2023 meltdown, right? So are we going to start to see now, a whole other mass of regional and mid-sized bank failures because of this? So before I jump into the stats and then share the article with you, it's something everyone should be really keeping an eye on here. And this is unfolding, let's say, separate from this whole NDFI credit exposure, okay? So 2023, and before I share this with you, as I always humbly ask, please subscribe to the channel if you're not subscribed. We're growing the community, really great to see, and to all those new subscribers over the last week or so, thank you for being here. It means a lot. So 2023 U.S. bank liquidity crisis, economic impact breakdown. Listen to this. Direct bank equity losses, $450 to $500 billion. Market cap destruction and unrealized losses. FDIC and government interventions, $32 to $45 billion. FDIC coverage for SVB, Signature Bank, and First Republic. Bank Term Funding Program, BTFP, $160 to $170 billion. Fed liquidity backstop offsets QT drain. Are we heading back there again? Okay. Private bank rescues acquisitions $40 to $50 billion, deposits and takeovers led by major banks, consolidation. Market cap decline, global finance, market cap decline $1.2 to $1.5 trillion. Global financial stocks draw down, okay? There's your stock market impact. Deposit outflows from small banks, $700 billion, shift to the larger banks. Again, consolidation. GDP impact, indirect, $120 to $200 billion. Lending contraction, reduced credit growth. CRE exposure losses, $80 to $100 billion. Valuation dropped in commercial property loans. Tech venture slowdown, 50 to 70 billion, reduced startup and venture capital liquidity. And lastly, consumer confidence equity effects, 500 to 700 billion dollars temporary wealth effect losses. So it was almost the aggregate U.S. economic exposure after that 2023 liquidity crisis meltdown was $2.8 to $3.5 trillion. Okay, so it was a big deal. So are we on the doorstep or the cusp of a liquidity crisis 2.0, regional bank crisis 2.0? Let me share with you a quick article I saw from the Street Insider that came out just a couple days ago that addresses the issue. Let me turn it. Sorry guys, my monitor popped on here. That addresses this. So this is U.S. banking system reserves dip below $3 trillion, which they say is a danger point, again, from the streetinsider.com. A decline in these reserves is a significant because it can lead to tighter financial conditions, increased volatility, short-term interest rate increase, and potentially restrict bank lending, impacting overall economic growth. The immediate market reaction has been one of caution, with some analysts issuing a liquidity warning. Large commercial banks, right, the too big to fail, globally systemically important banks, the GSIBs, are generally better positioned to navigate the landscape. JP Morgan, Bank of America, and Citigroup benefit from diversified revenue streams, robust balance sheets, and sophisticated liquidity management frameworks. Conversely, regional banks are likely to be among the primary losers. Institutions like Zions Bank Corporation and Western Alliance Bank Corporation just happens to be the two that got stung last week big time by the failure of the NDIF projects, right? To the tune of about $200 million. Going to be well over, probably $300 million just from that one investment group as this unfolds in the coming weeks. It says they're often more resilient on deposits and have less diversified funding sources. They're often more reliant, reliant on deposits and have less diversified funding sources, making them highly susceptible to increased competition for funds and higher deposit costs. A reduction in reserves directly constrains their lending capacity, particularly for small, medium-sized businesses, their core clientele. All right, this environment may accelerate consolidation within the regional banking sector, with weaker institutions becoming acquisition targets. So again, love to get your thoughts and comments. Is the Fed setting this up for, again, another round of what we went through, 2.5 years ago with the regional banks? Is there some larger plan here? So in the short term, the financial system could experience increased market volatility. Stocks, right? If you're in the stock market, go back and do your research. What happened to the stock market during that, several week swing when these things were blowing up in 2023? As liquidity tightens, potentially leading to spikes in overnight rates, echoing the 2019 repo crisis. Long-term possibilities include a sustained period of slower economic growth due to reduced lending capacity and potentially higher borrowing costs for the government if Treasury cannot meet its obligations. Okay, so again, this transcends a whole lot of other economic components, right? that make up the overall broad economy and markets. It's not just something that affects just the bank. So the key takeaway is that the era of superabundant reserves is drawing to a close, while larger diversified financial institutions like JP Morgan are better equipped to weather the shift. Regional banks face considerable headwinds, including increased funding costs, like I said, constrained lending capacity, and potential profitability pressures. The divergence could accelerate consolidation. That means bank failures, folks, right, within the sector. The broader implications, right, which include potential ripple effects on credit availability for businesses and consumers, and a renewed focus on robust liquidity risk management across the industry. Okay, and of course, this comes at a time when we're seeing the overlay of massive pressure from these bogus credit facilities, the NDIFs, the intermediaries. Okay, but this, I said in yesterday's video, that may be off a while. Okay, if the Fed keeps cutting rates, the blowup of the NDFI loans may be just delayed a little bit. So we're gonna make the problem bigger, but it's gonna delay it. But this liquidity issue, right? If the Fed doesn't come out and let's say immediately, I guess, announce, that it's gonna stop the quantitative tightening and the balance sheet runoff and do something to shore up these reserves, then we're gonna have, from a layperson perspective, okay, not an economist, not an expert, I'd love to get your thoughts. We're gonna have a crisis just like we did in 2023, but it'll probably be bigger, right? So again, is this all by design? Am I reading too much into that? But we have, again, big heads, big economic thinkers out there and analysts saying, hey, red flag, red flag. So markets, jumped high last week because all they care about right now is that further rate cuts are coming. It'll be cheaper money, more risk taking, and all the shenanigans we see go along with it. But this is a different aspect, and this is the liquidity crisis part, okay, not a credit issue. So understand the distinction. I appreciate you guys watching. If you enjoy the content, leave me a like on the video. If you're not subscribed, please subscribe, because there's subscribing to the growing channel. Leave your thoughts and comments. I do read them and appreciate that very much. And with that being said, this is going to be a very interesting week. It's front and center with the Fed meeting Tuesday, Wednesday, rate decision on Wednesday at the close. And let's see what the shock potential is. Okay, I'm not convinced that it's not all by design if you look at the history. Okay, thanks again for being here. Talk to you soon. Bye.